Welcome back. Let's get into that market movement now and see how things have fared this morning. It seems Asian fares downtrodden to begin with as the spike in new Chinese virus cases sent Hong Kong stocks tumbling and added to worries about the economic impact, of course, of that outbreak. But there were some signs that global financial markets may be regaining their composure after days of heavy selling had sparked by the epidemic, should I say. Some markets were able to gain partly because investors in these markets had already had a chance to react to the outbreak. Of course, Hong Kong had been on holiday for a while. That outbreak has indeed claimed more than 100 lives. Asian markets were able to pick up marginally, with the Nikkei picking up 0.7% by close of trade, 23,379 points there, while the Hang Seng, of course, came back online, collapsing a major 3% there to sit at 27,116 points. The Shanghai Composite remains closed for that public holiday, which now has, of course, been extended to February the 9th. Over onto Wall Street, U.S. stocks rebounded last night with the S&P 500 recovering from what was its biggest one-day percentage drop in nearly 4 months. A lot of that was led by a climb in shares of Apple and other names hit by concern of exposure to the coronavirus outbreak in China that has sparked a recent sell-off. Now, the Dow Jones Industrial did rise 0.6%, while the S&P 500 gained 1%. It's just above that 3,200 point mark. The Nasdaq Composite adding 1.4%. 9,269 points. All right, let's take a look then at the picture out in Europe. Of course, markets have certainly been quite interesting as well there. The FTSE 100 managing to gain ever so slightly. So a bit of a topsy-turvy market movement, however, with the DAX in Germany not necessarily seeing positive territory. The CAC 40 out in France still being able to accumulate some gains. On the local front, well, 1.5% higher for the JSE All Share, having really been downtrodden over the last few days. So the JSE All Share that we'll get to in just a second, you'll see a whole host of green sitting on the local market if we can get to that board. Hopefully we have that for you in just a bit as well then. But it really has been around the sentiment of that coronavirus and how exactly things have fared when it comes to demand for things like oil. Of course, the economic drag has certainly been of keen question. How much impact will that push onto markets across the globe? Central banks across the world will certainly need to then impose and really offer a whole lot more stimulus in order to counter all the economic drag that is likely to happen at a later stage. Hopefully we can get into that all share index now a little bit and just check in on those numbers. Slightly down for now at 55,724 points, with industrials and financials as well in that territory. Moving over then onto the commodities board, your resources overall are headed a little bit higher, with your platinum counter sitting just below that 65-point mark. Over into the commodities themselves, well, these have begun becoming some slight safe haven trading, with gold headed the highest there, $1,571 a fine ounce. A slightly better mark for platinum, which has lost a lot of its shine in recent days, having gone well above that $1,000 a fine ounce mark and now unfortunately languishing below. Nearly $65 a barrel for Brent crude, having sat as low down as around $58 a barrel. One would hope that it certainly continues to fall off for South Africa's sake, of course, in that regard. 14.59 then for a US dollar. A slight bit of strengthening, actually, considering where things have sat over the last 2 days. It is, however, down on today's trading. 18.99 for a pound, 16.05 for that euro. Over onto the BRICS currencies then as well. Well, some slightly positive movement across the board on these ones against the US dollar. Let's unpack this market movement now a little bit more with Michael Traherne, Portfolio Manager at Vestact Asset Management, joining us live from the Johannesburg Stock Exchange. Michael, thank you so much for the time. The JSE All Share has actually gained 1.5% today, so it's actually a much better picture. The platinum miners, big movement there, 6.33%. Perhaps some normality returning to the market, sold a little too hard?
Yeah, it's following on from the US stock market overnight. US stocks up over 1%. US investors basically saying, yes, there's coronavirus fears around, but it's probably not going to be a long-term problem. Chinese authorities look like they've got the situation under control. Numbers coming out overnight showed that the number of new cases of the coronavirus has started to slow down. And there's World Health experts busy being flown into China to deal with the situation. So as it stands, it looks like the situation's mostly under control, and the stock market saying, okay, well, if it's only going to be a short-term blip, let's take advantage of the recent selling that happened on Monday and Tuesday.
What becomes of keen question is that selling did create cheaper stocks, but had the market just run too hard and just found excuse to kind of sell off? Did it really need to sell off? And did the coronavirus really impact markets that badly? Does it normally on a case like this?
Yeah, so the stock market's general stance on these things is sell first, ask questions later. And I suppose that's what the market's doing now, is asking those questions, and people are realizing it probably did oversell a bit much. But in terms of looking at these things, you go back a few years, Ebola virus, that had a very big impact on the stock markets globally. Even though the Ebola virus was mostly focused on Africa, where there's not much trade and production going on, it still had an impact on markets. And if you go back even further to the SARS outbreaks in the beginning of the 2000s, it also had an impact on the virus. So it's you in the news headlines, you see all the reports of death of new people getting catching the virus, and then earlier in your news bulletin also talking about BA not flying to China anymore.
Yeah,
it gets into investors' heads, and they start questioning rather be on the sidelines, and I think that's what's happened on Monday and Tuesday.
Yeah, so somewhat of a recovery as well, and that oil price now at $60 a barrel, haven't gone really much lower, beyond at some point $58 a barrel. So somewhat of a recovery even there, perhaps saying, look, we'll be able to shore up the demand if need be, we'll be able to deal with the supply issues.
Yeah, so it's not even oil price. You'd look at most commodities, iron ore, you're looking at platinum, anything that's related to production had a really tough start to the week. But as people feel that things are going to start normalizing, as Chinese factories will start rebooting and starting up again once this week holiday is done, then the demand's going to be there. So as long as this is a temporary shutdown, I think markets start to normalize. The problem is if it extends long term, then you start actually missing out on production goals, you start missing out on factory orders, and that's a problem. Coming into this week, China was always going to be shut down for their New Year celebrations, so that's not unusual. It's only as the extensions to their holidays start getting a bit longer that you're really going to see a big impact from this year's numbers compared to last year's numbers.
Yeah, I suppose many will wonder then what happens to that Shanghai Composite Index when it does open, having known perhaps a little bit more of the facts and being able to digest a little bit more. And as you say, of course, you sell the rumor and buy the fact, as things often are. How would you feel, though, about the new CEO then at Tiger Brands? Noel Doyle takes over. He was CFO. Continuity, a good thing here?
Yeah, so he's been around at Tiger Brands for a long time. If you go back to, I think, 2 CEOs ago, he was passed over for the job when McClory was appointed.
Yeah.
A lot of people were saying they should have gone to Doyle in the first place. So he's been around, he knows how the systems work, he knows the people, and it looks like the board has grown tired with the current CEO, and basically it's given the market a 2-day notice that he'll be leaving and there's a leadership change. So let's see how he deals with the listeriosis outbreak, and let's see how Tiger Brands approaches the public in terms of claiming responsibility.
Yeah, I know primarily it was the age scenario that had come to fruition then for Lawrence McDougall, but do you reckon that it was also just perfect timing for Tiger Brands to be able to just say, well, you know what, you have reached that age and it's the perfect excuse for a time that has been really difficult for McDougall, and you can now pass up and really head out on this one?
Yeah, so it's, in the SENS announcement this morning, Tiger Brands points out that McDougall was up for a re-election at the AGM, and that's those sort of things you plan on a long term. It's not like his 63rd birthday just snuck up on them. And generally when a CEO has only been told, or they tell the market he's leaving in 2 days and there's no transition period, it generally means that the board has basically said, your time has come, thank you for your service, we think there's a different direction needed, and that looks like the case that's happened here at Tiger Brands.
Yeah. All right, reprieve then for South Africa's economy, you reckon? Moody's saying perhaps a little too early to judge whether South Africa's policies are really going to work in any way. Is that really just a smokescreen? I mean, we've tried the same policies, by the seams of it anyway, for the last 5 years.
Yeah, so I'd say it is a bit early, but it is worth noting that Moody's is saying we're keeping a close eye on the budget speech coming up next month. So I'd say you can't say what's going to happen until the budget speech happens. Do we get a VAT increase? People are saying that that's a good chance. If we do get a VAT increase, I'm sure that will appease Moody's and it'll help with the very big budget deficit that we have. It also depends on Treasury's forecasts about the future and our debt to GDP ratio, which is expected to get up to about 80% before stabilizing. So those are some very, very big numbers. But I think if you have a look at our bond market, you've seen the South African 10-year start to increase quite rapidly. And that's investors saying that, look, we think that more than likely there's still a debt downgrade on the cards. Maybe not at 27th of March, maybe later in the year. But just by the fact that our 10-year keeps weakening, it tells you that the market's trying to preempt what Moody's is going to do.
All right, Michael, really appreciate the help, bud. Thank you so much for that. Always good chatting there. Michael Traherne, Portfolio Manager at Vestact Asset Management. Let's get to unpack that market movement then, obviously a little bit after the break.